Okay, welcome to the webinar. Thanks everyone for attending today to our first of many webinars. Today's titled Stuff Over Paper. My name is Steve Allen. I'm the portfolio manager and managing member of SOP Advisors. Joining me on the webinar today is Darren Geiger, an advisor to the firm and someone with decades of energy and commodity experience. Stuff over paper, SOP, is literally in our name. Just The firm has been designed to take advantage of what we see as a multi-decade shift in relative valuation. Just to do some housekeeping to begin with. If you have any questions in the chat, please ask them, or comments please include them in the chat, and we're not going to address the questions in the webinar. We'll be addressing them after the webinar. Just to start off with some trivia, what do you think the best or second best performing stock is over the last 98 years? Well, the answer may surprise you. The second best performing stock over the last 98 years is Vulcan Materials. If you may or may not know, Vulcan Materials is an aggregate cement producer, which has produced a 14% annualized return over the last 98 years. 14% in what could be considered the most basic low-tech business you could think of. We, however, think basic commodity industries like this in agriculture, energy, raw materials, and metals will significantly outperform over the foreseeable future. In short, we believe stuff will outperform paper. So what do we mean of when we talk about stuff or hard assets? Hard assets generally benefit from inflation. They generally are scarce. They're not easily replicated. They generally employ little or no leverage. So some of the examples of this, what we'd be talking about would be real estate, energy, agricultural metals, either precious metals, base metals, any minor metals. So what are we talking about conversely? What are we talking about when we're talking about paper? Paper generally tend to be financial assets. They benefit from deflation, tend to be longer in duration. They utilize some degree of leverage. So examples of this obviously would be bonds, any type of structured finance or financial stocks. This chart here shows the CRB, which is a broad-based commodity index plotted against the S&P since 1985. And as you can see, stuff has generally underperformed paper over a relatively long period of time. Here's another chart showing the relative valuation of stuff versus paper. This is a chart showing the Mag 7, the market cap of the Mag 7 compared to the market cap of the top 12 global mining companies. As you can see, the top 10 Mag 7 are worth a combined 26 times the value of the 12 largest global mining companies. There's a significant relative valuation difference in the two. So having said that, why do we think now is a particularly opportune time to allocate some of your portfolio to hard assets? To begin with, we're going to give some context of why we believe this is the case. And to start off, we believe there's three secular changes that are taking place currently. One, we believe rates are in a general uptrend. Two, we believe inflation is going to remain persistent. And three, we think the dollar will continue to decline. It will no longer be the go-to safe haven currency. Just a chart showing the 10-year Treasury yield over a very extended period of time, and we feel that rates are no longer in this long secular down move, and we feel that down move has been pierced. And as you can see here, we believe that the rates reached their low probably in August of 2020 at 57 basis points. And as you can see also, these rate movements tend to be multi-decade in nature. And so we're roughly within the year 5 of this general uptrend in rates. As you can see from this chart, it's not a U.S. phenomenon only. This is a chart of the yields of the top G7 economies, and they're all generally in uptrends. This chart is a very interesting chart, I believe. It's this just chart that shows basically what the reaction in the 10-year yield after post-Fed easing. And you can see that we've seen the largest counter move against given a Fed ease outside of 1981. And in other words, what we're saying here is that rates, the 10-year Treasury yield went up 85 basis points post easing. So something different is going on here. What might that be? Well, part of it's related to demand. This chart right here shows the percentage of foreign central banks' treasury holdings. You can see it's come off precipitously. And Darren will talk later on in the webinar about why that's the case. But definitely that price insensitive buyer, which generally are central banks and also the U.S. central bank, are no longer buying treasuries at the clip they used to. So it's going to be definitely cause a problem going forward. Another problem going forward is going to be supply. And here's a chart of the deficit as a percentage of GDP. And what's interesting about this chart and why we included it is it just shows you that these spikes in the deficit generally have only and historically have only occurred during periods of crisis. So again, the severe recession of 1981, 82, you saw some spikes there. You saw again, a spike in during the global financial crisis, a spike again during COVID, but then you also saw this spike in 2024. So again, we're starting to see these spikes in the deficit outside of crisis. So what we've termed here is that the deficit itself is becoming a crisis. And what we're seeing here, what we see here in these charts is more of the same. Just this combined shows the combined interest expense as of the latest most fiscal year end, and as also as a percentage of GDP on the lower part of the chart. And so it's obviously that a deficit is becoming a problem as it's becoming a supply overhang, which is again that supply will clear, but it'll clear at ever higher and higher rates. The other thing that's going to be persistent is inflation, and that's going to will continue to cause issues with the bond market. So Darren's going to speak to inflation.
Thanks, Steve. So again, another secular shift which feeds back into higher rates is elevated inflation. This chart is of core PCE since late 1999. This is the Fed's preferred inflation gauge because it excludes just about everything, including food and energy. And it hasn't been close to the Fed's 2% target since 2021. The latest reading this past Friday was 2.9% year over year, so it seems pretty clear that 3% is the new 2%. Now, outside of government numbers, there are several independent or shadow groups that put together more realistic gauges of inflation, and they're almost always much, much higher. This next chart is from a group called Trueflation, and they scrape 15 million prices off the internet on a daily basis. And since April 2nd, or Liberation or Tariff Day, which is the vertical dotted line, this measure is now tracking at an annualized rate of 4.22%. So again, materially higher than the Fed's target, and even higher than the core PCE rate. It's our belief that inflation will remain persistent because the tailwinds that kept inflation in check for decades have reversed and are now headwinds. This next chart is a long-term view of the CPI. From 1994 to 2017, the CPI averaged 2.2%. And this was essentially due to the start of NAFTA, so frictionless trade. A little bit later, China entered into the WTO, which exported deflation around the world. So generally speaking, we had global capital flows were smooth. Well, starting with Trump 1.0, as well as the onset of COVID, you see a spike in the CPI as global trade was restricted and supply chains were challenged. This led to security of supply at any price. With Trump 2.0, free and open trade has largely reversed. We have trade wars with large trading partners, primarily China, tariffs with just about everyone, and sanctions on large energy and commodity exporters in Iran and Russia. So the result is upward pressure on prices. And this is all going on with a very real risk of over-easing, with President Trump replacing Fed Chair Powell May of next year and jostling with Fed governors now. Next chart depicts how inflation has played out over the last 10 years, overlaid against the period during the 1970s when conditions were quite similar. And it's uncanny how closely they track. If this turns out to be prophetic, inflation is heading materially higher. In the next chart, we show how investors should start reconfiguring their portfolios to protect themselves. So everything on the left-hand side of the dotted line falls within the real asset category and dramatically outperform when conditions were last most similar. Note what's on the right, what performed worst is the US dollar. And this segues perfectly into our next secular change, which is a long-term decline of the dollar. This next chart shows it's messy, but it shows each year's year-to-date value of the dollar since 1967. This year is the bold line and is the worst year-to-date performance since 1986 at negative 10.3%. Only 1986 and 1973 have had worse year-to-date performance over the last 58 years. So it certainly seems as though we are in a prolonged dollar debasement environment. And this was initially sparked by the US and EU arbitrarily seizing Russian-related assets in response to the Ukraine invasion. This had major ramifications. It showed that the US, among others, was willing to act arbitrarily and unilaterally outside of international law. And as Steve touched on earlier, treasury holdings by foreign central banks, such as the Saudis, the Chinese, have materially declined. So they clearly took notice and adjusted accordingly. Over the last 10 years alone, foreign central banks have cut their treasury holdings by over 30%. And that's a problem for a country like the US that has to finance a massive budget deficit. This next chart reflects what is replacing treasuries by central banks, and it's gold. Central bank gold holdings now reflect over 20% of total foreign reserves, the highest in 29 years, while treasuries held are the lowest since 2008. So there's perhaps no better example of de-dollarization than gold's demand and price ascent. Year to date, gold is up nearly 50%. And if you look at this next chart, it enhances the point even further. Year to date performance of all major commodities is very telling. The top four performing commodities year to date are all precious metals. So investors are looking for something that can offset inflation, and real assets and commodities which are priced in dollars tend to be supported by currency weakness. And with that, I'll hand it back to Steve.
Thanks, Darren. We talked about some of the secular shifts that are taking place. I think our next discussion is going to be about some of the geopolitics and the geoeconomic events that are taking place currently. And while a lot of the discussion most recently has been deglobalization, and then there's been some with the tariffs that were placed on in the first Trump administration and were kept in place during the second administration. Again, there's been this talk about, is the world deglobalizing? And the fact is that none of the numbers that are currently coming through would bear that out. And here's a chart just basically showing that China's on pace to have another record trade surplus. And this chart just basically shows that the trade's getting reconfigured. It's the trade moving away from trade with the U.S. and moving to other trading partners, some in the East, but also others such as Africa. But again, the point in both of these charts is that deglobalization is not what's occurring. So what is occurring? And we believe that what's happening is a bifurcation or a fracturing, and that fracturing is occurring along lines versus east versus west. And nowhere is this better seen than in what happened in commodity flows after the inception of the Ukraine war. This chart right here shows the flows of crude oil, sanctioned crude oil, flowing from Russia, flowing east to most specifically China and India. And conversely, these are the flows going west, and these are flows from Europe, or excuse me, from LNG from the U.S. to Europe to fill in the gap that was left by the shutdown of the Nord Stream pipeline. So again, this fracture is between East versus West. It's those countries in the East, which is interesting, tend to be high knowledge, high income based countries, very few commodity producers with the exception of Australia and Canada. The countries aligned with the East tend to be mostly commodity producers and tend to be autocratic in nature. So in short, the East has a huge head start and a huge leg up on the West in terms of its control and association with major commodity producers. And we see this playing out in real time in rare earths in particular. And here's a chart just showing how much China dominates the rare earth market, both at the primary production level, but also on the processing level. But again, it's not only rare earths. We see it across a number of other strategic important commodities. And here's a chart just showing lithium, nickel, copper, and cobalt, both production and processing. And while China is not necessarily the leader in some of these materials, they are definitely the leader in processing across almost all commodities that we talk about, and that's going to present a problem going forward. So basically, when it comes to raw materials and particularly some strategic minerals, the West is being forced to play catch up. And we're seeing that in real time now. We're seeing almost daily now ways that the West is trying to play catch up. We saw the Trump administration place a tariff on copper earlier in the year, again with the expressed intent of trying to jumpstart the U.S. domestic copper industry. The problem is that the U.S. is by no means self-sufficient in copper, and I think that became readily apparent to the administration. So those tariffs were taken off. We see the administration there's some talk of trying to establish a strategic stockpile. I mean, all of the things that we're talking about are very Chinese-like in nature, and there's been some criticism about the U.S. for that. But again, these are all ways that the U.S. is trying to play catch up. Um, they've actually even taken an equity stake about 3 months ago in a domestic rare earths producer. And a couple of days ago, actually, they took an equity interest in a domestic lithium producer. So again, these are all ways that the U.S. and the West are trying to play catch up with the Chinese in particular in gaining a toehold with some of these strategic and important raw materials. And the reason that they have to do that is expressed by this chart right here. This is a chart showing how long it takes on average for a new greenfield mine to come into production. In the US, it takes about 30 years to bring a new mine into production. So obviously, to address some of the shortfalls in the near term, bringing new production online, excuse me, is not an option. The other event that's taking place outside of this clash between East versus West is somewhat of a rift amongst the West, and specifically among the Europe and the U.S. And some of this rift has occurred because of the belief that the U.S. can no longer shoulder all of the defense spend. And there's been some discussions, and finally, at the beginning of this year, the EU decided and others decided to start paying more of their fair share. And we see this in this next slide, basically just showing how this initial defense spending affects the GDP and the GDP ratios of some of these EU countries. But I guess the most important thing is, from our perspective, is what happened in Germany. Germany, in February and March of this year, decided to release their debt brake. And the debt brake, as you may or may not know, is basically their self-imposed fiscal discipline. The Germans have been very good about spending, and as evidenced by this chart, and their debt to GDP ratio has stayed fairly stable. But with this new spending package that they agreed on in March of this year, then that debt brake will come off, and they'll start spending significantly on infrastructure and defense. And this next chart shows just how much that spend will be. It's close to $1 trillion, 500 billion of which is on infrastructure spend, and the balance is 400 billion on defense. But I think the important takeaway from this whole slide is that Europe's finding ways to jumpstart their own growth initiatives, and this is going to be highly um, positive for all commodities. No webinar would be complete again without a talk of AI, and we're not gonna shirk our responsibilities here. And Darren's gonna talk about AI and how it relates to the things that we've been talking about.
Thanks, Steve. Steve's right. AI has touched just about everything in the markets, so we're here to discuss it. This chart that you see shows the extent of data centers just in Virginia, which is home to 35% of all hyperscale data centers worldwide. So from our perspective, we're seeing a convergence between the tech industry and the physical commodity world in ways we've never seen before. I mean, these are generally service providers historically, which for the first time have huge capex outlays as a result of data center construction, and the dollar numbers are simply massive. To provide context, in Q2 2025 alone, data center capex by the hyperscalers reached 127 billion, a 72% increase year over year. This next chart shows just how impactful AI has become in our capital markets and the potential risks of that narrow leadership. So 41 AI-related stocks make up close to 50% of the value of the S&P 500. And since ChatGPT was introduced in November of 2022, those 41 stocks account for 75% of the S&P 500's returns, 80% of earnings growth, and 90% of capital spending growth. So an important point here to make is that large equity indices, such as the S&P 500, are now exceedingly concentrated. And while dominating the markets with world-changing claims, advances in AI will only occur to the extent that the constraints imposed by the physical world allow it. And that starts with energy. As this next chart shows, power demand is expected to grow 4x over the next decade, primarily driven by AI. These are growth rates of power not seen in modern history. So electrification power has replaced oil as the energy headline these days. The fact remains access to that power is and will remain the gatekeeper to AI's realized trajectory. This next chart depicts why you've seen dramatic moves in anything that could feasibly power a data center. So things such as gas turbines, nuclear, battery storage, solar, backup generators. This then trickles down to more ancillary business lines such as transmission, connectivity, materials, cooling systems, you name it. But this is squarely SOP's target environment. These are industries we cover almost exclusively. So on the next chart, there are pockets, however, where investment is lacking, or CapEx is lacking. The first shows copper, which has a supply-demand deficit that is expected to grow significantly over the next decade. And CapEx for the energy industry is stagnant, which is inconsistent with the demand for power that we will be experiencing going forward. About 90% of what is currently spent by upstream producers is simply to offset the depletion of existing production. So while the capital markets have figured out the need for power, water, and other ancillary industries, insufficient CapEx indicates that the ability for the industries to deliver on that demand is stretched. Thus, many industries have yet to spend the necessary dollars to keep up, and the result is that prices need to go substantially higher to incentivize new supply. And these higher prices will further drive outsized returns in the names we've covered for decades. With that, I'll pass it back to Steve to wrap up.
Thanks, Darren. Yeah, we believe that having covered these markets for decades, we feel like this point in time is some of the best entry points that we've seen in our careers. And essentially it's because of one, and the secular changes that we're seeing in inflation, in rates, and the dollar make the fixed income portion of your portfolio is not able to provide the utility that it once did. And this chart right here shows exactly just that. This is 60/40 portfolio measured against the flat S&P index, and as you can see, its usefulness is it severely drops off after 2020. So again, that fixed up income part of your portfolio is going to be a drag on returns, and actually it's going to work against your return portfolio. Again, the second thing that's adding, fuel to the fire, so to speak, in terms of a tailwind for commodities is the east versus west dynamic that we talked about earlier. And we think this is only going to intensify and broaden against to include other commodities. We're already seeing it in copper, aluminum, and some other larger, deeper markets. And this is only going to get more and more intense as time goes on. We think that's going to be a broad, again, tailwind for commodities in general. And add to that the resurgence in Europe and the bid for underneath all commodities gets even stronger. And finally, as Darren has pointed out earlier in the webinar, and I just want to reiterate here, those that are tied to an index um, are severely exposed to several stocks. And right here is a slide showing how imbalanced the S&P has become, with NVIDIA making up almost 8% of the S&P. The top 10 stocks make up over 40% of the S&P. So again, this broad-based index has become anything but, and we believe it's highly susceptible to any chinks in the armor of this AI story. And this is a chart right here showing the correlations among a number of different sectors to large cap growth stocks. So the Mag 7 would fall into that category. The single best diversifier against large cap growth in the US is commodities. So in short, to hedge against any problems in the Mag 7 or the imbalanced index that we see, buy stuff. And we stand ready to help investors do just that. We work with investors to give investors exposure through specialized, personalized, actively managed portfolios in the sectors that we talk about, whether it be energy, agriculture, minerals, mining, or any of the ancillary industries. These portfolios are specialized, and we provide liquidity and transparency on Schwab and other platforms. So again, thank you for attending the seminar. This will be the first of many. Please follow us on LinkedIn and also on Substack. We also share a lot of our thoughts on what's happening in the commodity markets, but also in the capital markets in general. So thank you for attending, and look forward to speaking again.
Thank you.